Hello, it's Big Cheds, and this is the Trading Encyclopedia Daily Education series on my YouTube at Cheds Trading. You can find me on Twitter at Big Cheds and Bitcoin Live, where I am a founding analyst. For today's lesson, we're going to talk about the idea of DCA, or dollar cost average. Now, I talked about it here as an investment strategy, and we can go over that. It's also a trading strategy. And the idea essentially is that you're buying just a little bit at a time in the investment strategy. So you're not sure that you have the time to watch the chart. You don't think you can nail a bottom or get a perfect entry. You really just want to get some exposure. And this is actually something I've told my friends for a long time. For example, if they want some Bitcoin, just buy $25 a week, buy a certain amount. Every week you dollar cost average, and then over time, you do just fine if it's an uptrend, right? You don't want to dollar cost average. If we take this chart and we flip it upside down, this is not something you'd want to dollar cost average into. You want to dollar cost average into an uptrend. So that's a very important first point. But here's the idea that over time, here's the price is moving up and down, but you're slowly adding, and your portfolio rises because your average cost is equal essentially to the trend. And then we continue here. It gives you another image of what it means to dollar cost average, spreading out your purchases over time. So you're less focused on timing the market, right? Not everybody can read a chart. Not everyone can properly identify support and resistance, and or even want to do that. But here's your average price. You just dollar cost averaging over time. So let's look at an example of how you might have applied that to Bitcoin. So let's take, for example, this most recent bottoming you had here. Now, so let's look at it for a trading standpoint. I talked about investing. You just buy a little bit, right, every week. And your whole point is, I want exposure, okay? And you'll get that exposure over time. Now, with the trading strategy, you can dollar cost average in the sense of you're scaling into your position, right? And you're not investing, you're trading. So, for example, maybe you took your first entry on the descending supply trend break, which actually also corresponded here with this lower high break. And then maybe when it breaks here at 20K, you bought a little bit more. And then maybe even up here, when it came back and it broke this peak, you bought a little bit more here. So you weren't sure it was the bottom in this case, but it looked like a bottom was forming. We know bottoms are slow to form. What you were able to do was you were able to spread out your entry to 1, 2, and then 3 positions, right? And by the time this third position hit, it's a confirmed downtrend. We have the 2-level filter break, and your average price is somewhere here in the middle, right around 20K. So that's the whole idea. The whole idea is if you're dollar cost averaging something, you don't think you can time it. You're not going to be able to nail each entry. You just want a little bit of exposure over time. You want to make sure it's an uptrend, right? You don't want to dollar cost average a downtrend. And with trading, it's a way for you to scale into your position. This is dollar cost averaging, or DCA, and this is the Trading Encyclopedia Daily Education series on my YouTube at Cheds Trading. Find me on Twitter at Big Cheds and Bitcoin Live, where I'm a founding analyst. Thank you, folks. I hope you're doing well. Talk to you soon. Big Cheds out.